Hi. In this video, I'd like to showcase a position I entered into yesterday. It's a SPY put ratio spread that I got into shortly before the close for 0.45. The long leg is at 435, and the short leg is at 428. The idea was that this 428 level is well below the last support level. Essentially, I was playing a short-term decline with this. Put ratio spreads become cheaper when volatility rises. Today, as we know, the market continued to fall, so there's a nice gap down, and I'm curious to see how it reacts. I intentionally gave it a short expiration to keep the position relatively delta negative. Even when I entered, it was already delta negative. If I had chosen a longer expiration, the trade would have been credit, not debit. And it would essentially have had a positive delta, so I would have had to wait it out. This, however, is deliberately a shorter-term trade. So for now, it's going against me, but it's still in profit because time is passing by, even though volatility has also increased, and this is negative vega. So the profit curve looks positive for now. But of course, if the market starts plummeting, this will likely turn negative. So that's the trade I entered into shortly before the close yesterday, and for now, it's slightly in the green. We'll see where it goes from here. Alright, back again. Today is the 26th. The last time I recorded was on the 21st when I entered this position during that red candle. We were around the 435 level at that time. Since then, we've dropped further and are now below my short strike at 428. To reduce my risk a bit and widen the range, I executed the following adjustments. I rolled the 435 down to 434, bought back one of the 428s, and moved it down to 426. I was able to do this for a 0.03 credit, so the strategy has now evolved as such. If you look, my upside risk hasn't increased. It's remained the same as it was initially, given this is a credit transaction. However, my lower break-even has moved quite a bit to 420.4 from 421.4, so it's moved a point away and obviously the peak has decreased. Now if we look at it, my current positive delta is 6.7. While before the adjustment it was a 12 positive delta. That's good if the market rises, but if it continues to drop, I don't want to sit in this with a high positive delta, so this adjustment dampens that. So here's a screenshot confirming the transaction. It went through just a few minutes ago as a single combo order. That's what the position looks like now, and we'll continue from here. Alright, back again, it's still the 26th, and the market is about to close. The odds of further decline have become quite significant. So, for safety's sake, I decided to also roll down the other side of the position. I rolled the previous 434 down to 433, which already had some profit baked into it due to the continuous downward movement. I also moved the other 428 down to 426. The previous adjustment was made for a credit, but since the decline has accelerated and volatility increased, this could only be filled for a debit. So this went through for a 0.17 debit. Now the strategy has reverted to having a peak, and the stock price is fairly centered. Initially, I had an 18 positive delta. Now I've rolled it down to a 12. I've increased my risk, especially on the upside, although not by much. However, my break-even point moved further down. This 420 level should be more than sufficient for us by Friday, but you never know, especially after a nice drop like this. The break-even is right under 420, so the position should be fine up to that point. I think this is again in the category of overstretching a bit before a reversal. We had a dead cat bounce yesterday, which turned out to be exactly that. A dead cat bounce, as it didn't continue. That's an ugly continuation because often what happens after a dead cat bounce is some sideways consolidation before another drop, which would have been good for this position. Having a big green candle yesterday and then suddenly reversing to red today isn't a good sign and doesn't show the market wanting to correct much. We'll see. There are only 3 days left until expiration, and it's pretty well centered. Here's the screenshot confirming the fill. You can see it was done for a 0.17 debit. I rolled down the 434 to 433, bought back the 428, and made it a 426. So, that's the adjustment for today. And I essentially touched the position twice. We'll see if it's enough. If I hadn't done anything, I would be sitting at a 26 delta, which could be good if the market bounces back tomorrow. But I wanted to balance this out a bit, and that's why I made these two adjustments. Maybe the first one would have been enough. We'll find out. So, that's where we are now, and we'll continue from here. Well, it's the 27th again, and it looks like the downturn hasn't stopped, as we continue the day with another red candle. So I had to adjust the ratio again. Last time, we had a 433 and 426 iron condor set up. What I did was tighten the 433 to 431 by 2 points right away, and I bought back the 426 and wrote a 424 instead. This got filled at a 0.75 credit, meaning there's no loss to the upside anymore, essentially taking that off the table. And I further pushed the lower break-even point to 418. It's still worth considering moving these levels down a bit more. For instance, bringing the 431 down to 430 and pushing the 424 down further to 422. But that will likely be a debit transaction, exactly, a debit. So now we've also crossed the 424 level with a trade like this. That would bring the lower break-even to 417, and I'm still good to the upside, so I'm still mulling that over. I'm curious to see if there will be any bounce because this is pretty brutal, dropping from 445 to 422 in just 5 days. This decline is pretty harsh, and despite having such a nasty red candle today, the VIX only went up by about 3%. However, the dollar has started to rally, and the TNX keeps climbing, which is obviously not good. The yield on the 10-year Treasury note is now up to 4.6%. We recently had a gap up to 4.5, now it's at 4.6, and accordingly, the TLT is plummeting. So, this September seasonality is really kicking in nicely. That's pretty much what happened. I pushed the lower break-even point further, and there's no more loss potential on the upside. It's showing a very nice theta, and there are still 2 days left in it. I'll show you the screenshot of the fill. Here it is for a 0.75 credit. I closed the 433, bought the 431, closed the 426, and entered into the 424. So that's where I'll pick up next time. Here we are again. It's the 28th Thursday, and there's just 1 day left in this position. It looks like we've got a little mini bounce happening about a half hour after the open, and I'm in a delta neutral state right now. However, if we get a bounce, it would be slightly better to be in a more positive delta. So what I did was tighten the 431 down to 430 and pulled the 424 up to 425. I received a 0.98 credit for it, and so it's adjusted now. You can see it's become narrower, but there's more guaranteed profit to the upside, and the break-even has come up again, approaching 420, with a positive delta of 10. Now, if I've guessed wrong and this is just a dead cat bounce and they pull it back within the first half hour, then obviously this is not a good position to be in, with a positive delta of 10. So that's the adjustment that has been made. Right now, I could close it for around 160 in profit. Here's the screenshot of the fill, which happened just a few minutes ago for 0.98 credit. So that's where I'll pick it up next time. Here we are again, it's the 29th, and today is the expiration for this SPY put ratio. Essentially, this gap up didn't really do it any favors because yesterday, it was even around a $210 profit. However, I've closed it now, as it has pretty high negative theta, especially on this last day. I was checking to see on the SPY matrix, there's a possibility that we almost came down to this bottom level, and it now seems like it has bounced back. I didn't want to leave it to the last minute because if it runs up to here, I could make multiples of the profit, but I didn't take that risk. So I've closed it out with a combo trade for a 0.65 credit. So the net result for this put ratio was a $179 profit. Here's the screenshot of the fill. It went through at 0.65 a few minutes ago. Now the funny thing about all this is, if I hadn't done anything with this initial position, guess what the profit would be? $320. I would be at a $320 profit if I hadn't touched it at all. Obviously, I couldn't have taken off the risk, but I would have been much better off doing nothing. If I had just done the first adjustment, I would be at a $247 profit. If the second, then $176. If the third, then $129. So, it's good that I did the fourth as well because it ended up at $179, thanks to this bounce back. So, essentially, with this 0.65 close, it's a $179 profit, based on the initial $45 premium or risk. It's hard to say what the risk is in such a short ratio as it's inherently unlimited, but if you look at the cost of entry, it was $45. Of course, the margin is much more than that. So that's about it. Hope these adjustments were useful. If you have any questions, feel free to reach out. Thanks for your attention. Bye.